Hello and welcome to the Business Standard Morning Show. My name is Ishan Gera and here are the stories for the day.
What the world needs now is people who see energy a little bit differently. Because seeing a more sustainable world isn't far in the future. We're building it now. GE, building a world that works.
Amid fears that India's demographic dividend may turn into a demographic threat after years of high unemployment rates, Prime Minister Narendra Modi on Tuesday announced to recruit 10 lakh people in different central government ministries and departments over the next 18 months. And on the same day, the government also announced a radical recruitment plan for armed forces, under which 45,000 youth will be inducted for a 4-year tenure. So will these steps help address India's unemployment problem? Today's segment will seek to answer these questions.
Battered by demonetization, the pandemic, and subsequent lockdowns, the Indian economy has started showing some signs of revival now. In May, the number of employed people jumped by 1 million. It resulted in a drop in the unemployment rate from 7.83% in April to 7.12% in May. Economists, however, are skeptical. Some say that it is difficult to get the real picture of unemployment from the methodology used by the Center for Monitoring Indian Economy, or CMIE. The same CMIE, however, recently conceded that more than half of the 900 million Indians of legal working age, roughly the population of the US and Russia combined, are not looking for a job at all. Amid these numbers, Prime Minister Narendra Modi on Tuesday announced to give central government jobs to 1 million people in the next year and a half. In February this year, the government had told Rajya Sabha that there were over 872,000 vacant posts in central government departments as on 1st March 2020. As many as 910,153 vacancies existed as on 1st March 2019 and 683,823 as on 1st March 2018. The government had also said that the Staff Selection Commission, the Union Public Service Commission, and the Railway Recruitment Boards had recruited 265,468 people during 2018-19 and 2020-21. India is still far behind the US, China, and others in public sector employment. In 2015, there were nearly 39 million public sector employees in China. This would mean 5% of China's workforce had public sector employment. The corresponding figure for the UK in 2021 was 17%, and for the EU, it was 18%. In the US, 6.9% of the total workforce was employed in the government in 2020. This does not include state government employment. If we were to assume that state employment is 4 times that of central government and armed forces employees, India's total public sector employment would be in the vicinity of 20 million. Even after an addition of 1 million, India will still have only 2.2% of its total workforce employed in the public sector. In August of 2020, a McKinsey Global Institute report had said that India needed to generate 90 million non-farm jobs between 2023 and 2030 in order to absorb new workers and an additional 30 million workers who could shift from farm work to non-farm sectors. The report had said that to absorb this influx, India would need close to 12 million additional gainful non-farm jobs every year starting in financial year 2023. This would be triple of the 4 million non-farm jobs created annually between 2012 and 2018. The government on Tuesday also announced a major reform in how soldiers will be recruited for the Army, Navy, and Air Force by way of the new Agnipath scheme. Under the model, soldiers will be recruited from those between the ages of 17.5 to 21 years. These Agniveers will serve for 4 years. Defense Minister Rajnath Singh has said that this scheme will increase employment opportunities with new skills in different sectors. Under this scheme, most soldiers will exit the service in 4 years. Out of the 45,000 recruited annually, only 25% will be allowed to continue under permanent commission. According to one report, the model will make the permanent force levels of the country's armed forces much leaner, so its net impact on employment generation remains to be seen. As reported by Business Standard, an urban job scheme along the lines of the National Rural Employment Guarantee Scheme is back in debate after a report commissioned by the Prime Minister's advisors recommended it. The report, commissioned by the Economic Advisory Council to the Prime Minister, has recommended such a scheme based on its assessment that a gap between the labour force participation rate in rural and urban areas is widening. The government also has an ambitious target of generating over 6 million jobs in 5 years from the production-linked incentive schemes. Meanwhile, in the private sector, employers are reporting the most optimistic hiring outlook in 8 years. Job creation is likely to see a boost in the September quarter.
This would definitely provide an immediate relief and opening up, but this would call for basically reasonably qualified and skilled people to get absorbed in government jobs. It will make a marginal but positive impact on the overall unemployment situation. I would also like to observe that we have a rural employment guarantee scheme, but we do not have a counterpart urban employment guarantee scheme. The nature of labor in India is that it is migrating between urban and rural areas from time to time. Because urban employment is also temporary, it arises in certain seasons and so on. So in those periods where urban employment is not available, people migrate to rural areas just to take avail of the employment guarantee scheme in the rural areas. It would be far better to conceptualize a comprehensive employment guarantee scheme, which is either a separate but complementary urban employment guarantee scheme or merge the two, so that independent of the location of the unemployed people, some kind of temporary relief can be offered while people train themselves and skill themselves up in order to get absorbed in the openings that would come up. One misgiving that policymakers often have is that this may cost so much excessively that the Indian fisc may not allow this. However, we should consider that when the two schemes are operating side by side, then a lot of people who otherwise are in urban areas but claim the benefit coming back to the rural areas, all that duplication would be avoided, and therefore it would not be just a linear expansion of the rural employment guarantee scheme. And these two schemes can work in tandem and complement each other.
Even though offering an urban job scheme could have a significant impact on the central exchequer and the states, given the immensity of India's job creation challenges, is it time to bite the bullet?
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं?
ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं?
वो तो सबसे आसान है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
The government is also working on a mission mode to address the problems faced by consumers. On Monday, it asked food business operators like Zomato and Swiggy to submit a proposal on improving the consumer grievance redressal mechanism and reveal breakup of all charges, including the surge pricing to consumers. Our next report tells more about it.
India's Consumer Affairs Ministry has lately taken a host of measures to protect the interest of consumers. It is locked in a prolonged battle with the restaurant industry over the imposition of service charge. Early this month, the ministry asked restaurants to stop the practice of levying service charge by default, saying that it did not have legal sanctity. The government, in its guidelines issued way back in 2017, had already said that entry of a customer into a restaurant cannot itself be construed as a consent to pay service charge. But most restaurants continue to levy this charge. The National Restaurant Association of India, or NRAI, has issued a statement saying that the service charge is legal and the Department of Consumer Affairs is yet to take a call on the new framework. According to reports, the government is now mulling prohibiting the practice through an amendment to the Consumer Protection Act 2019. And now, even as there seems to be no end in sight to this battle over service charge, the government has opened another front against the food services industry after hundreds of consumer complaints. On Monday, the government asked online food business operators to submit a proposal to improve their customer grievance redress mechanisms. The proposal, which has to be submitted in 15 days, will also include steps to be taken to make billing more transparent. According to reports, 2 food business operators have received over 3,500 complaints on their consumer helpline. These complaints have now prompted the Consumer Affairs Department to ask operators like Swiggy and Zomato to transparently show consumers the breakup of all charges included in the order amount, such as delivery charges, packaging charges, taxes, surge pricing, etc. The directions came after a meeting between Consumer Affairs Secretary Rohit Kumar Singh and major e-commerce food business operators. The food delivery platforms were also told to show individual customer reviews transparently and refrain from showing only the aggregation of reviews.
So I think this is something which is ongoing since a very long time. And if you look at a platform like Zomato, there are certain restaurants wherein they are unable to charge a take rate due to the inability of that particular restaurant to pay the take rate because the take rates are phenomenally high. And basis that there are 2 options for Zomato, either to delist the restaurant or probably take the take rates from the customer. So there are incidences like this wherein the prices of the product are much higher as compared to a restaurant menu, and the prices could be almost about 40 to 15% higher versus the rack rate. So Zomato is not only asking you for a delivery fee, for the convenience that it is offering in terms of the food being delivered at your doorstep. They are also charging a hefty fee for that particular food product because the restaurant is not able to pay the convenience fee. So I think transparency for Zomato Swiggy would mean that they probably have a system where they can notify the customer while the customer is kind of placing an order or going through the menu that the prices of the food products here are 15% or whatever, 14% higher as compared to the rack rate menu prices. And if the customer is willing to pay that premium and willing to take that brunt of take rate which the restaurant is not paying to Zomato, they can go ahead and order the food. But I think this transparency is a win-win for the entire ecosystem. For the customer, is good because the customer is aware in terms of what he or she is paying for. And for Zomato also, it's very clear from their side too that they are charging a fee. Currently, as we speak right now, there's a lot of ambiguity on this. So, a certain set of customers are aware about this fact that they are paying a higher fee for the product as well as the delivery charge which is being charged by the platform. But there are also a certain set of customers who are unaware about this. So I think, to make it more transparent, there has to be a new system in place which has to be integrated on their platform. So I think there are concerns from the regulatory angle as well. In the last few weeks as well, we have seen many new announcements. I think the most recent one was that advertising by online betting platforms is now banned. Now, what these kind of moves do is that, there is a negative impact in terms of your customer acquisition strategy because internet business models are very new in terms of, coming into India. It's been almost about 4 to 5 years that they have emerged. So it's very important for them to advertise and, kind of function freely across the board. So overhang or a headwind in terms of regulations will definitely, keep their growth rates under check. So growth rates for now have been in the range of about 25 to 30%, because there is a big story in India around consumption and penetration. So I think the regulatory headwinds are a risk, for growth rates in the medium to long term.
According to an official statement, Swiggy received as many as 3,631 complaints, while Zomato registered 2,828 in the last 1 year alone. According to the statement, 803 complaints received by Swiggy were for deficiency in services. 628 complaints were filed for delay in delivery of products, 456 complaints were over delivery of damaged products, 401 people approached the helpline over delivery of wrong items, 391 complaints were filed over non-refund of paid amount, and last but not the least, at least 100 people complained after receiving non-vegetarian food instead of the vegetarian food that they ordered. Meanwhile, the complainants flooded the consumer helpline of Zomato too. While 707 complaints were registered for deficiency in services, 499 complaints were over delivery of damaged products. 307 complaints were over the paid amount not refunded, and 298 people dialed the helpline after getting wrong products. Scores of people also registered complaints over discrepancy in delivery time between the promised one and the actual time taken. Absence of a mechanism to separate genuine reviews from the fake ones was also raised. In most cases, like what happens in other platforms too, those associated with the restaurants post scores of positive and motivated reviews about it. According to reports, the Restaurant Association NRAI raised the issue of customer information not being shared by the e-commerce food delivery platforms with the restaurants. The association said that if the eateries get the contact details of consumers, they will be able to serve them better. In April this year, the Competition Commission of India had launched a probe against Zomato and Swiggy over alleged unfair business practices in their dealings with restaurant partners. The CCI move had come after NRAI asked it to investigate the food delivery companies for breaching platform neutrality by providing priority to exclusive contractors. The probe report will be submitted in 60 days' time.
यार मत पूछ यार, फिर से स्टॉक्स में फंस गया। तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर। इसमें बहुत तामझाम है। तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
After food business operators, let us move on to markets and economy. With a stronger than expected surge in headline US inflation at 8.6% in May, the US Federal Reserve is likely to march towards aggressive monetary tightening policy at the end of its two-day June meeting. However, the inflation punch, coupled with recession fears, poses a dilemma before the US Fed on the quantum of rate hike without derailing growth. Our next report takes a dive onto what to expect from the US Fed meet and whether investors would be able to withstand the likely market rout.
As consumer inflation raised to a 41-year high in May, the US Federal Reserve will be determined to increase interest rates by at least 50 basis points at the end of its two-day policy meeting later today. FOMC minutes in May too signaled commitment to raise interest rates, reduce balance sheet, and move into the restrictive territory. Analysts at HSBC believe the Fed will launch 3 series of 50 BPS rate hike in June, July, and September. Global investment bankers like Barclays and Jefferies make the case for 75 BPS rise in interest rates. However, if the US Fed raises the benchmark rate by 75 BPS, it would be the biggest hike seen since 1994. Analysts fear this would ultimately unsettle global investors and fuel steep declines in the US equity as well as bond markets. As far as this week's policy is concerned, markets are baking in 65% chances of a 75 BPS rate hike. But analysts believe that an extremely hawkish commentary from the US Fed would roil the markets going ahead.
Inflation, as we know, is born out of food and fuel prices, which are not going to abate in a hurry. In this scenario, the Fed has a choice to front-load interest rates in this cycle versus continue with their 50 basis point rate hike over the next 3 months or so. Markets are now expecting, to the extent of 60-65% chance, that the Fed will hike 75 basis points in this cycle, and they will guide maybe a higher raise in the next cycle also than 50 basis points. It remains to be seen. There's also some discussion yesterday about some market participants expecting the Fed to raise 100 basis points in this cycle. Clearly, if they were to raise 75 or 100 basis points after having committed 50 basis points in the last cycle, it would basically mean that they are more scared, more worried about inflation than they were previously. And that could potentially cause a fall in all asset prices, equities, bonds, commodities across the board.
Kunal Walia of Waterfield Advisors too believes that the 75 BPS rate hike would trigger a broader market sell-off.
The Fed is likely to deliver its second consecutive 50 basis point of rate hike this week and announce several rate hikes over the next 12 to 24 months in an attempt to bring down the multi-decade high inflation. The Fed is further going to continue its quantitative tightening program, which it started in June, and which is likely to gather pace over the next few months. So 50 basis point of rate hike this week, on top of it, a very hawkish interest rate view from the Federal Reserve is something which we expect. As investors, we need to note that a 50 basis point rate hike coupled with quantitative tightening program which is in place by the Federal Reserve are pretty strong tools to bring about controlled inflation over a period of time. In case if the Fed decides to give larger than expected 75 basis point of rate hike, then the market sentiment is going to turn negative further, and there could be a broad-based sell-off in various asset classes.
Historically, the US Fed has kept interest rates in the range of 2 to 4% to balance growth. The global central bank started to raise interest rates from January 2022 to tame the red-hot inflation. Till now, it has launched 3 series of rate hikes, totaling to 1%. The tech-heavy Nasdaq composite has bled the most, sinking over 31% so far in 2022. Meanwhile, the S&P 500 and Dow Jones have slipped over 21% and 16% respectively during the same period. Moreover, the US 10-year Treasury yields have climbed over 1% this year. Overall, an unexpected rate hike may send markets into a tailspin, casting a spillover effect over others as well.
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Investors looking for an international exposure need to understand various categories of economies and the inherent risks involved. In our next report, we will explain what the various categories of countries are and the things to keep in mind before investing there.
A diverse portfolio helps investors hedge concentration risk. And while portfolio or investment diversification is important, locations or economies where you put your money is equally crucial. When you turn towards international markets, you have the options of investing in developed markets, emerging markets, and frontier markets. Let us understand what each of these markets are and how can one invest in them. While there is no one standard definition of each of these markets, experts point out that there are a number of characteristics that are hallmarks of each. For instance, developed nations usually have more advanced economies, better developed infrastructure, and higher per capita income. Western economists consider $15,000 to $20,000 per capita GDP to be a sufficient range for developed status. That apart, developed economies are also characterized with highly developed capital markets, regulatory bodies, and high household incomes. However, a high per capita GDP alone does not confer developed economy status without other non-economic factors such as infant mortality rate and life expectancy. For example, The United Nations still considers Qatar, which had one of the world's highest per capita GDP in 2021 at around $62,000, a developing economy. This is because the nation has extreme income inequality, lack of infrastructure, and limited educational opportunities for non-affluent citizens. Overall, various organizations including World Bank, the United Nations, MSCI, FTSE, and Standard & Poor's consider about 25 nations as developed economies. These include Australia, Austria, Belgium, Denmark, Canada, France, Germany, Hong Kong, Italy, Japan, New Zealand, Norway, Portugal, Singapore, Spain, Switzerland, the US, and the UK. According to the World Bank, countries with low, middle, and upper middle incomes per capita relative to incomes in other countries around the globe are labeled as developing or emerging. Developing countries or economies are those which do not enjoy the same level of economic security, industrialization, and growth like the developed countries. It includes the nations that do not have the economic strength of developed nations but are in the process of becoming developed economies. It pegs per capita income for emerging markets between at $4,095 or less. But for investors, the emerging markets offer a greater amount of liquidity as well as stability. Emerging market countries include BRICS countries: Brazil, Russia, India, China, and South Africa. Besides, Mexico, Pakistan, and Saudi Arabia are other developing economies. The third one is frontier market. They are somewhat less advanced capital markets in the developing world. These markets are in a country that is more established than the least developed nations. It is still less established than the emerging markets because it is too small, carries too much inherent risk, or is too illiquid to be considered an emerging market. That is why they are sometimes called as pre-emerging markets. So, based on these criteria, frontier markets include the likes of Colombia, Indonesia, Vietnam, Egypt, Turkey, and Nigeria. So, if you want to invest in these countries, here are a few things you should know. One of the easiest ways to incorporate stocks from various markets is to purchase shares in managed funds. Secondly, bear in mind the risk, liquidity, and growth potential of a given country before investing. That apart, investors must balance the strengths, weaknesses, opportunities, and threats before investing in a particular country. They should also make trade-offs and place bets among debt, equity, domestic, international, growth, and safer options.
I will achieve, I will fly high.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
A CRISIL report of 2017 said that the average return of a diversified equity investment in India has been around 18% CAGR since 1997. That's all for today. For more news and analysis, log on to businessstandard.com. We'll be back tomorrow with the next episode. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views, and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram, and LinkedIn.